welcome to Bloomberg Quint. We've got the fourth quarter data for the Indian economy. We'll read out the numbers and then get some analysis. Gross value added growth for the fourth quarter was at 3.7%. For the full year, gross value added growth was at or rather there was a contraction of 6.2%. GDP in Q4 grew by 1.6%. For the full year, it contracted 7.3%. A brief note that we're looking at gross value added data, more importantly this time around, because there is a subsidy adjustment which is depressing the GDP numbers. But for all of that and more, joining us, Saugata Bhattacharya, Chief Economist at Axis Bank, Aditi Nayar, Chief Economist at ICRA. Aditi, congratulations on your promotion. First time we're speaking since then, but good to have both of you here. Saugata, let me come to you first. Headline numbers, and if you can help us understand why we are looking at GVA a little bit more and what the message there is vis-a-vis the GDP.
So very briefly, GDP is GVA plus indirect taxes minus subsidies, basic accounting. So indirect taxes had increased this year. Indirect taxes and subsidies also had increased. So obviously, when a negative number increases, obviously the overall number increases more. So I mean, a negative of a negative is positive. Yeah, so that pushes up GVA. And that's the reason from the initial 6.5% GVA number, I mean, in the second advanced estimates, we've gone down to gone up to 6.2, contraction, better number. Whereas for the GDP number, it's gone up from about 8% to 7.3%. So that's the number for the GDP has increased. Subsidies, we were our own headline number was 7.5%, instead of which the actual number came in at 7.3. So for the subsidy number, what was, and we got the numbers for March just a while back. They have spent 1 lakh crores more from their revised estimate numbers, of which about 60,000 crores was for paying down various installments of the previous subsidies that they had given, the loans that they had taken from NSSL, so 60,000 from there, and 40,000 additional subsidies. Now, it's still not very clear, because what the accounting treatment would be for that 60,000 crores that was used to pay back the loans. Now we know that the 40,000 crores would be adjusted against the subsidies. So that's the basic story for why there is some residual uncertainty about the treatment of subsidies, and why that residual uncertainty will persist into FY20. That's something that we need to worry about.
Okay, I'll get to that. But Aditi, your takeaways from the headline numbers and how you are seeing this subsidy adjustment? Hi, Aditi, if you could hear me, I just wanted to get your initial thoughts on both the headline numbers and the adjustment of subsidy between them.
Yeah, so, Ira, the way we look at it, we had pegged the Q4 GDP growth at 2% and the GVA growth at 3%. So what we've got with these numbers, and I fully agree with Saugata that the confusion in terms of both the subsidy number and the accounting treatment for it is something that we had also, really wondered about how to actually build that into our GDP and GVA forecast for Q4 of FY21. And what we've got now in terms of the initial data from the NSO is a GVA growth of 3.7%. So that's a fair bit higher than our forecast of 3%. But the GDP growth for Q4 is 1.6%, which is lower than our 2% estimate. So now, of course, the question is, has the pace of growth exceeded or fallen short of our expectations? And that's a difficult question to answer when GDP and GVA are pointing in different directions as compared to our forecasts. But I think the takeaway is that growth did improve. Both GDP growth went up as compared to Q3, so did GVA. And the extent of the same is faster as far as the GVA number is concerned. So perhaps given all of these confusions in terms of subsidies, where they were booked, how they were booked, etc., it may be a better idea to actually look at the GVA expansion in Q4 as the leading metric to analyze what's happened as the economy has sort of track this recovery path over the last several quarters. Now, to my mind, first of all, industry has done better than what we expected, and it's been a volume-led improvement. But we can't totally write off the fact that we did have the low base because the nationwide lockdown had started in March of 2020. So there's a little bit of impact of that. But overall, we did see in many sectors that volume growth was significantly better in Q4 as compared to Q3. And that's something that has pushed up the industrial numbers. So the service sector numbers have actually trailed our expectations, and particularly the contact intensive services, were the quickest to get impacted by the second surge in COVID. And there is evidence that we're seeing of that in the Q4 GDP data as well.
Okay. Now, Shweta, can I come to the breakups, and I'll come back to some of these fiscal numbers because we did get the fiscal data for FY21 as well. So if one looks at the sectoral numbers first, and please correct me if I'm wrong, it appears like there was what was anecdotally being spoken of, strength in manufacturing, certainly a rebound in construction. So at least some of that on-ground activity that people were speaking of in Jan to March did show up in the numbers.
Yes, indeed. And even the sectoral breakups were pretty close to what we were thinking. I mean, so manufacturing, we know that, multiple segments, multiple sectors, including metals, steel, aluminum, all the metals segments, chemicals, to a certain extent, auto, as a result, consumer durables were doing very well, and pharma and some of the other sectors. So we knew that manufacturing had revived. In fact, and in March, people were talking about many industries operating at 100% capacity.
Yeah.
So that's manufacturing. On the services, on the construction side, one part came in from the government capex spending. Although I'm yet to see the fiscal numbers on how much the government had certainly budgeted for a large increase in capex spending. So and anecdotally, all the metros and the other road construction works, etc., had been progressing apace. So some part of construction would have come in from that. The other part was residential housing. So as we know that there is still in the second part, in the last part of the fourth quarter, residential housing was still progressing fairly rapidly. Good construction activity, good booking activity. Although it had come down from the December January numbers. So these are the two segments. These are the two parts of construction that would have contributed to construction, the growth in construction, and manufacturing was doing well. Agriculture, I was a little surprised. We were a little higher than what had actually come in. So probably some part of the very good Rabi harvest will probably show up in the Q1 of FY22.
Services also, Aditi, if you want to jump in on any aspect of the industry data, but even on the services side, there was nothing dramatically surprising, right? Trade hotels continues to be the segment that's hurting the most. Finance was a little bit perhaps softer, I'm not sure entirely why. And then, of course, public administration grew this quarter, which one would have expected it to.
Yeah, so we were actually this is the same confusion that Shobha and I have both spoken about earlier. How do you build in the subsidy and the overall back-ended expenditure of Government of India into the Q4 numbers? So the way we were looking at it, the way we had done our estimation, we actually thought that public administration, defense, and other services would end up showing a higher growth because it would get pushed up by Government of India's expenditure, even as the contact-intensive part of the other services segment would continue to seriously trail the pre-COVID levels. So I would say that is one segment that has actually come in a little lower than what we had projected. And overall, the service sector growth has trailed our expectation. Agriculture is pretty much in line with what we had forecast. We had put in a 3% growth, and the number which has come in is 3.1%. So the view we have is that even though the Rabi crop was progressing very successfully, and we're expecting to see a very good harvest, because last year's base is actually very high. So the incremental GVA growth on top of that is not going to be terribly high. So we're looking at FY22 as well, agricultural growth only being maybe 2 to 2.5%. Even if we get a normal monsoon, we don't think we're in for a very sharply higher agricultural growth than that.
Okay, understood. Shweta, the expenditure side, can we derive from it to say that even consumption had started to recover in the fourth quarter before the second wave hit? Investment was also reasonably strong, as was government spending, which we all probably know. Shweta, you've gone on mute.
Sorry. So yes, consumption was recovering. There's no doubt about that. So one aspect of consumption that we forget, that this is very intimately linked to the fate, to the progress of the MSMEs, the micro, small, the unincorporated enterprises, the proprietorships, etc. It is these one or two employee companies or enterprises which also form a large part of the total consumption basket. So these enterprises had begun to recover. The cash flows had recovered, and partly thanks to the ECLGS program. I mean, that had helped to stabilize this particular segment of industry, of enterprises. So that was recovering. Cash flows had improved. The economic activity has improved. Obviously, if construction, where migrant workers come back, construction improves, cash flows improve. Obviously, consumption would also begin to go up. That's the worry. That how much consumption, particularly survey after survey, indicating a major hit to the small enterprises. How much construction? I think it's down about 9% in last year. So how much construction consumption will get hit particularly in Q1 and Q2 of FY22 is a concern. Investment, of course, investment is down pretty significantly. Government capex central government capex had helped to stabilize it. The worry is that state government capex, which had been the largest component of government capex over the last 3 or 4 years, not the central capex. The state finances have taken a big hit. So how far that segment of capex can be sustained in FY22 also remains a concern.
Okay, that state capex doesn't get captured in this data, does it?
No, it does.
It does. Okay.
The state government finances gets captured in this data.
Okay. Sorry, apologies for that. Aditi, as we were chatting offline before there's very little we can derive from this data to take it forward, right? I mean, Q1 is going to be an entirely new ball game. There's no way to understand whether this strength in consumption is going to continue. It probably won't. How much will it, sort of decelerate by? No idea. How much manufacturing will come down given the staggered and, disparate nature of lockdowns? Again, no idea. So, Q4 is a good number to have in the time series, but I'm not sure what to take of it for the current economy.
Absolutely. We are looking at a lot of uncertainty, and any range of outcomes that can actually end up manifesting in FY22. On the one hand, we have some states where the COVID cases seem to have peaked, and we expect that they're going to start their unlock processes, and it's going to happen in a staggered manner going forward. But a lot of Q1 is going to be hit. And my argument is this time it's a demand problem, and that sentiment is going to be weakened for households because of the actual health crisis and the fact that disposable incomes are getting squeezed very badly by the healthcare expenditures for a lot of people. And the rural economy, which really sort of buffered the overall economic activity last year, has seen a bigger spike in COVID cases this time. So that's something that's not going to really be able to provide as much of strength to the overall economic activity as what we saw last year around. So we're definitely in a complicated situation, even without having had a nationwide lockdown. Now, looking ahead, I would argue that the sentiment is going to recover slower this time than it did last year. And we've got two contrasting forces going ahead. Will the vaccines get rolled out faster than what we are expecting right now, especially to young adults who make up a very large part of our population? And will that be enough to really avert a third wave? These are questions that are very difficult to answer at this point in time. And depending on which outcome we think has a greater probability, the associated likely GDP projection for this year ends up being very different. So I'm going to offer you a wide range, very uncharacteristic and not very comfortable position to be in, but I think that's the most realistic situation at this point in time. We think that GDP in FY22 can expand between 8 and 9.5%. So not a double-digit growth, which we were hoping for this year, somewhere between 8 and 9.5%, depending on which of these extreme outcomes ends up being the actual situation in FY22.
Shobha, when the second wave initially hit, a lot of reports were generally along the lines that this is a recovery sort of interrupted but not, completely thrown off track. Is there confidence in that analysis even now that, as things open up, some of this consumption that had started to pick up will come back on stream, or are we back to sort of square one or completely different picture?
So a few things. One, there's been a permanent scarring of income, big scarring. So compared to where our alternative growth path would have been without the COVID, and where we are now, and where we will be in FY22. we've probably permanently lost about 50 to 60 lakh crores of income. So that's gone, permanently gone. Secondly, in terms of and whatever, as Aditi says, we are at about a real growth of 9 to 10.5%, anywhere 9.8% centered. So this year in FY22. Question is, what can they regain a 6% potential growth in the years ahead? I mean, say 6.5, 7% or whatever. My own sense is I'm relatively more optimistic on that score. We've lost a lot of small businesses. Yeah, in the course of the first wave and the second wave, the ongoing second wave, we will have lost a lot of small businesses. The sorry part of all this is that this range of small businesses, lower income households, actually contribute to a very small part of the overall GDP. It's not a good thing to say, but it's the truth. So the hit on this will not detract from the bigger picture story of the larger set of our economic activity. Plus, on top of this, if the government actually follows up on some of the reforms that we have seen, some of the good structural reforms, which unfortunately only seem to come in the times of crisis, if we can leverage on some of these, say for instance in the manufacturing sector, the PLI schemes, although I'm told other than a few sectors, there are still many glitches in the PLI schemes. So if we can increase our competitiveness, if our healthcare spends increase, if government capex spending increases, our infrastructure, so the ability of people to buy houses farther away from dense downtown areas and consequently less expensive, etc. So in all of these changes, plus on top of that, the biggest boon that has come in from this slowdown, as you know, is digitalization. So now, I mean, technology is so pervasive in tier 2, 3, 4 towns. So, I mean, if we can use some of the technology to increase our efficiencies, I'm certain we can go on to higher growth. Problem is, again, I mean, the other side, that because of this increased digitalization and the use of technology and automation, although our productivity would certainly increase, there is the question of job security. How to fill that gap in the jobs is something that needs to get a lot of policy.
Aditi, there was also, I mean, so on the fiscal side, I know that the support, the fiscal impulse, as you all call it in economist speak, was not that, substantial for the current year. I'm just wondering whether because of this second wave, two things will happen. One, some of this infrastructure push from therein that was being spoken about just physically may get delayed. So the money coming into the economy may get delayed. And secondly, do you think there's going to be enough disruption to government finances to make them rethink where they're spending, how much they're spending, whether they need to put money into transfers rather than what was planned so far?
So let me offer a few thoughts around the fiscal side. One, if we look at the FY21 provisional estimates, what we've been suspecting for the last couple of months has actually turned out to be the case that our revenue receipts were significantly better than what the revised estimates had projected. And because of that, Government of India has been able to prepay some liabilities related to the FCI that were planned for FY22 in FY21 itself. And despite that, the fiscal deficit is just a tad lower than what the revised estimates were. So this is doing two things to the fiscal situation for FY22. One, the growth that is embedded in the budget estimates for FY22 for tax revenues is now only 10%. So to achieve the FY22 budget estimate for gross tax revenue, all we need to do is to go by 10%. And this is a nominal figure. And both Chogato and I are talking about, if I heard Chogato correctly, the range, our combined range for real GDP growth in FY22 at the low end for me is 8.5%, and I think Chogato's high end was 10.5%. So nominal GDP growth is going to be significantly higher. We've got a CPI inflation that's going to be at least 5% this year. WPI inflation is going to be significantly higher than that because we've got a double whammy for commodity prices. So I don't think that we're under too much stress of a collapse in the tax revenues, particularly compared to the budget estimates, unless we have a very severe third wave going ahead that leads to fairly debilitating situation for at least one quarter out of the remaining 3 quarters of FY20. RBI has given more money than what was budgeted. Disinvestment was always a question mark, and I think with the second surge, definitely that's the biggest risk on the fiscal side, is that we're going to have a big shortfall if multiple big ticket investments or disinvestments don't work. On the expenditure side, we've already, we've got a cushion of 1 trillion which has appeared on the expenditure side. That's the good news. Government of India has already announced about 40,000 crore extra spending between the free food grain for April-May and the fertilizer subsidy that they've enhanced recently. And I'm fairly certain the amount required for NREGA is going to be higher than what was budgeted for this year, because that was a step down over the revised estimates for last year. So potentially we've got about 18,000 crore in extra spending between these three programs and a cushion of 1 trillion which exists. So there is some amount of leeway to be able to push some fiscal support in FY22, but it's not huge. And I think we will be in a situation that the government will have to look at being more efficient in terms of the spending that it's doing, and really looking at compliance-led initiatives to push up the revenue growth as well.
Shweta, how do you see government finances? And I'll just add on two sub-questions to that. I don't know if you've seen the fiscal data that came in, but essentially it says what you were explaining at the beginning, that it is that large adjustment of subsidies, which is, I think, upwards of 3.4 lakh crore repaid to NSSF from the FCI's pool, which is keeping your deficit at close to 9.5%, a little bit below that. I think 9.3 is what it comes out to based on the GDP numbers used in the budget. But if you actually look beyond that headline, they managed to keep net tax revenues higher year on year between FY20 and FY21 because of excise. Potentially in a year, which is this current year where growth rebounds, things should be manageable for the government on the revenue front. Unless, of course, non-tax goes off track, but that's a small part.
No, non-tax is significant. I mean, so if non-tax, a lot of it is disinvestment. So I completely agree with Aditi that the big ticket, BPCL, Air India, LIC, disinvestment, etc. I mean, is a big question mark. There's no doubt about that. But on the tax side, I'm more confident. As Aditi mentioned, I think the growth estimates projections were very moderate, were very conservative, is in line with whatever growth numbers are being projected. Secondly, I think they have built themselves a lot of headroom for higher spending. The additional money, 50,000 crores given from the Reserve Bank, they will get more dividends from all the oil companies, HPCLs, BPCLs, IOCs. They will get much more than they had budgeted from these companies. In addition, they're carrying and the repayment of the FCI loans from NSSF. Having been paid down, that increases the headroom for FCI to borrow part of the subsidies from NSSF. The government itself has room to borrow more from NSSF. Government has built up a large cash balance, which it brought in from FY20, much more than was budgeted in the borrowing program. But like a stuck, so I think the center has room to spend. I mean, obviously, 1.5 lakh extra crores for the GST compensations to states, etc. That is some additional borrowing that will come. Again, like a stuck record, I'm worried about states. So till now, they have been doing relatively okay because of the oil, the ad valorem oil sales taxes that they have because of the high price of petrol, diesel, and other fuels. How long that they can manage with that, and the other revenue sources seems to have taken a severe hit. So that's one worry, that how much, despite the transfers from the center, the states might be able to absorb in terms of their ability to spend more.
Okay. Sorry, I'm saying with you for a second. In the beginning, you said that the subsidy adjustments will impact FY22. Did I hear that right? If so, why would they impact this year? I thought it had all gotten cleared out in last year.
This for me, right?
Yes.
Yeah. I mean, I hope it has. Fingers crossed that it has got completely wiped out. But remember that NSSF is still owed some money. I mean, it's not completely zero. Okay. So, I mean, that might need to be cleared out in FY22. My own guess is it will actually increase, not go down, because FCI will probably borrow more from NSSF. But I don't have the numbers with me. the huge increase that you had seen in FY19, that had actually come down in FY20, and then further, very small amount remaining in FY21. But that small amount in FY21 would also need to be adjusted. How that is treated accountingly, not being the cash accounting systems, how the accruals are treated is something that we will have to wait and watch. But there is still that amount, that small amount that remains from FCI borrowings from NSS.
Okay. Last question to both of you, just wrapping up. The week is bookended by macro events. You've got policy now coming up. Aditi, broadly, not very much for monetary policy to do, I'm assuming, except perhaps remain accommodative, keep sort of playing down the inflation story, even if it's looking a little bit worrying, maybe.
Yeah, broadly, we're expecting a status quo policy, extension of the accommodative stance, possibly a slight upward revision in the CPI numbers, and I would guess that we're going to get a downward revision of the GDP numbers. So let's see if that comes through in this policy, or if they, allude to uncertainty now and wait for another couple of months before they change the GDP projection. And also, let's see if the GSAP 2.0 gets announced this time around, or again, if there's an announcement later toward the end of June.
Saugata, what do you want the MPC to do? I asked, what do you want? Because what you want has to be the right thing to do.
No. No, thank you. But imagine, they're not in a happy situation. Obviously, the hit to growth, they will have to accommodate for a much longer time than we had earlier expected. At a time when inflationary concerns are rising, commodities prices, edible oils, crude, certainly. And crude is the thing that passes into Indian inflation. WPI inflation at 10.5%, the highest since God knows, 2004 or 2002. They will have to keep an eye on inflation, but at this point, I don't think they will be able to become more adventurous in terms of cautioning on inflation, as all global central banks, as you know, are doing. Transient is the word that we hear now. But there are risks, but they will have to keep on accommodating, and it certainly pushed back the timeline for normalization of policy, at least till Q4 of this year, not before, because they will need to get this down on infections.
I'll leave it at that. Thank you both so much. Very kind of you to join us here on Bloomberg Quint with the analysis, Aditi, Saugata, and thanks so much for watching Bloomberg.
Thanks, Ira.
Thank you. Thank you.